Hello and welcome back to this week's market update. This is Frank filling in for Kelly on Friday, May 12th. This week has been a pretty quiet week, giving investors a much needed break from all the scary headlines that we've had recently. Trading was off to a slow start as traders awaited the latest CPI readings for April. The Dow ended up closing down 1.09%, while the S&P was down about 0.5%, and the Nasdaq closed slightly up at a positive 0.07%. With the Fed increasing rates for just about a year now, starting in March 16th of last year, we want to know how's inflation been reacting to their efforts. Excluding food, energy, and transportation, the latest CPI ended at up 0.2% month over month, and that's a positive 3.4% year over year. The recent inflation data is showing some stickiness towards the higher price regime, which is most evident after you remove food and energy and transportation, which are traditionally excluded because of their volatility. The term stickiness is somewhat of a technical, quasi-technical term in economics that describes a phenomenon where prices don't adjust quickly to changes in supply and demand. So if you were to increase supply or decrease demand, and you would expect the price to go down, but instead the price remains elevated for a time, that would be considered a stickiness. What we're seeing now with inflation, very obvious, especially after you remove the volatile food, energy, and transportation numbers, you see that it has been persistently remaining high. Even though it has been moving down, it's higher than what would be expected considering the speed of the Fed's inflation efforts. And this is it's good news for consumers that it's been going down over the past 14 months, with the exception of a couple months here and there. But for the by and large, it has been going down, but it is exhibiting a little bit of stickiness and remaining persistently elevated, even though the Fed has made significant efforts to try and tame that. Unemployment insurance claims this week, ending the week of May 6th. The seasonally adjusted initial claims were 264,000, which is up 22,000 from the previous week. This is the highest level for initial unemployment claims since October of last year, so quite significant. And it's always interesting to look at these numbers. We always look at them at the national level, but I think this time it's interesting to look at them at a state level and see, well, which are the states that are contributing or detracting from these numbers the most. And so in this last report, what we've seen is that Massachusetts actually contributed the most to these numbers at almost 4,000, while Kentucky was at 3,600, Pennsylvania at about 1,000, and Virginia just around 800. And Colorado at 700. So those are kind of the top contributors, while the largest detractors were New York at 9,500, Illinois at 26, Georgia at about 1,200, and New Jersey at 7, and then Ohio at 500. So it's just really interesting to look at how each state contributes to these unemployment numbers. Bank stocks are still suffering. There were no bank failures this week, but banking stocks continue to suffer major volatility. PacWest Bancorp was the latest bank to be featured on headlines. Thursday, the bank stock sank 23% after the bank's securities filings with the SEC revealed that about 9.5% of its deposits have been withdrawn by clients. This slide has been putting pressure on other mid-sized banks. Meanwhile, shares of the largest banks remain unaffected. Oil prices are continue to slide, but the slide is starting to flatten. This was a third straight week of oil price declines. This is becoming the longest decline of this year. Last month, the oil cartel OPEC slashed its oil production by over 1.1 million barrels per day, and it was widely expected by many analysts that the production cuts would cause oil to surge as high as triple digits because of this. But instead, we saw it slide sharply due to economic concerns that the Fed's interest rate hikes would cause a slowing of economic growth and then a resulting, decrease in demand for energy. Brent crude closed out Friday flat for the month at $74.24 a barrel, while WTI crude fell 75 cents to close at $70.12 a barrel. This week was a quiet week, giving many investors a much-needed break. Oil prices are on the decline, easing pressure on consumers' wallets as we head into the energy-intensive summer months. And despite the diminishing economic conditions, the U.S. stock market has remained relatively resilient, and we are maintaining our view of taking a measured approach in allocating to risk-on and risk-off assets. Well, that wraps up this week's update. As always, we are constantly monitoring the markets and geopolitical events that matter to you and your portfolios. Thank you, and we look forward to providing you with another update next week.